afternoon, and welcome to the June 2013 webinar from retirementhomes.com. This month, we present Dale Abrams, president of Abrams Financial. Dale is an expert in personal financial planning and will share with us the three biggest financial risks that retirees face. Now, please welcome Dale.
Thank you, Rob. Just want to take a second to thank Robert and Retirement Homes for having Abrams Financial here today. We are very excited to be here. And without further ado, let's get into the webinar. So, today we're talking about retirement risks. And before we get into a little more detail, I just want to address a general question that a lot of my clients ask me when it comes to retirement. And that question is, how much planning can you really do in your life? Is there a magic formula to determine whether or not you're able to live the life you want to live in that next stage? And the answer is yes and no. There are some things you can do today to plan for the future and create habits that will give you fulfillment in the future. But you have to take the step and accept the fact that you can directly affect the course of your future life and your enjoyment of it. All you have to do is plan ahead. It should be no surprise to you that most people don't take the time to build a plan for their lives that address their lifestyle goals. Generally, most understand they need to develop a financial plan and would do so if they were in the right position. They equate a financial plan with a life plan, but they fail to understand that financial security in itself doesn't guarantee life happiness. A life plan doesn't have to be an all-encompassing plan covering every aspect of your life. It can be as simple as undertaking to build a plan to spend more time with your children or grandchildren, or a habit of quitting smoking. The power is you decide what your priorities are and where you believe you would benefit from making a change. Whether your life plans are big or small, the process you use is the same. If you're like most of us, you tend to treat planning for the future much like the person standing on a train track, staring at a fast approaching train. You can see it from a distance, but you think it's so far away. Of course, though, inevitably, it will pass our spot on that track. Just as inevitably, we will have to jump out of the way quickly to avoid being hit. Have you noticed how things don't move as quickly as you get older as they once did? We've noted that life planning can be big or small, and that no one can tell you when or how you should plan. It is effective to look at your life, establish goals for yourself, and then set about to create the habits to reach the goals. The goals that you set will be a function of your stage in life and a thorough appreciation for what it is that makes you happy. So let's get into a little more detail. The agenda today is we're talking about those three major risks. The first one is market risk. The second one is longevity risk. The third is health risk. We're going to touch briefly on task risk, which involves proper estate planning. And we're going to be talking about a lot of risks today and the impact and significance of each of these risks. But we're not going to be talking about a lot of products in detail or solutions. So if you are interested in solutions later on, please, we'll address that later at the contact for retirement risk solutions. Okay, so market risk. Talking about changing investor priorities. We've got words here from the investment guru, Benjamin Graham. The first rules of investment is don't lose. And the second rule of investment is don't forget the first rule. And that's all the rules there are. We spend all these years during the wealth accumulating phase getting ready for retirement, blood, sweat, and tears of our money and discipline saving this money, that the last thing we want is to lose that capital that we've spent so hard saving for. So what's the challenge? The challenge is market volatility. In addition to market fluctuations, there are other pitfalls you need to avoid. A high percentage of stocks offer potential asset growth, but they also pose considerable risk. You have fixed interest products that will minimize your risk, but greatly increase the potential for running out of income due to low return rates. So we're looking here at the possibility of your money lasting for 30 years if your portfolio consisted of 20% equities and 80% fixed income in bonds. And if you had to withdraw 6, 7, 8%, the likeliness is not that your money is going to last for 30 years. So we're looking at today's investing environment. Let's take a look at the past and present of today's investing environment. Historically, every long bull market, the bull market is known as positive returns year after year, and a bear market is known as negative returns year after year. Historically, every long bull market has been followed by a long bear market. This is a trend recognized by some of the leading investment experts around the world, including investment guru like Sir John Templeton. If we take a look at some of the past bull and bear markets, the cyclical nature of investing becomes easily apparent. What is even more interesting is the corresponding lengths of these components of these cycles. For every long bull market, history has shown a correspondingly long bear market. Although the ups and downs of the markets are unpredictable, the decline of the most recent bull market in 2000 ended in an 18-year upward trend, which leads us to believe we are in a corresponding long bear market, as seen in the past 3 years. We have seen the dramatic rise in equity valuations through the late 90s, with the subsequent dramatic fall from which many investors have yet to recover from. So, talking about the last decade, if we were retiring during those years and our monies weren't structured properly with the right portfolio and the right asset mix, then we're going to be having problems. And the news, the media, everything was coming to us with all these issues and tragedies, financially, personally, emotionally, nature-wise, tsunami. We had the Lehman Brothers collapse, the AIG bailout, and the list goes on. Nightmares on Wall Street. We got all these articles that are in our faces all the time, basically telling us that the period between 2000 and 2009 was not a good time. And Time magazine really summarized it by calling it the decade from hell. So, let's talk about that last decade for a second, and we can look at some of the major indexes to see how the investments performed during that time. The Dow fell by minus 9.3% during that decade. The S&P 500 dropped 24% during that period of time. And the NASDAQ plunged 44% over those last 10 years. So if you're during this time span, and again, you're not invested properly, then your portfolio that you've worked so hard to maintain is going to be taking, or did take, a serious fall. Now, a lot of my clients ask me, during this last decade, can I make up for a lost decade of investment? If you put your money in the TSX, it would only return 3.9% during that time. So what's the challenge? Today's investment challenge is, where do we put our money? We want it to be safe in things like GICs that are going to pay 1 or 2% that are highly taxable, or do we put in equities for the growth and to make sure that we have a nice retirement throughout those years? But the issue is, there's that risk and return argument that you have to weigh upon, because the greater the risk, the greater the return. And are you willing to take the bad market? There's got to be something in the middle here that is steady and consistent, and there are definitely tons of products and solutions that address that. Let's talk a little bit about the psychology of investing. Let's take the individual investor that doesn't use a financial advisor or portfolio manager. What usually happens is they get a great stock tip and they get really excited about this investment. Usually when they come in though, that's at the point when that investment in the stock market is at its peak. And that's the point of maximum financial risk. Then the markets tend to go into a downward spiral, and that's a temporary setback. And the investor becomes in denial, and now what normally would have been a short or midterm investment turns into a long-term investor. And the point when they decide and they panic, saying, maybe the markets just aren't for me, that's actually the best time and the point of maximum financial opportunity to get into the markets. But usually at this point, we've now locked in our losses, and that's going to significantly affect our retirement. So when we look at investment versus investor returns, if you just stuck your money in an index fund at the S&P 500 during 1984 and 2004, you'd be really happy. You'd return 13.2%. But the actual average individual investor only returned 3.7%, which is telling us that it's really important to let the experts be experts. We want to go to the best doctors when it comes to medical advice. You want to be dealing with the best financial advisors and portfolio managers when it comes to your money, unless you're prepared to watch it on a day-to-day basis. So we're talking about retirement now. So what's the greatest retirement and market risk? The challenge, we call it the sequence of returns. Investing in equity markets can help a retiree stay ahead of inflation and grow retirement savings, but there are specific risks for individuals entering or already in retirement. Once retired, the investor can't afford short-term losses in the same manner like a younger investor could, because their time to recover from these losses is limited. It's not about time in the market, and that's what people think. Oh, if I'm in the market long enough, I'll make more money. It's about timing of the market, and that's the sequence of returns. In a market downturn, the effect of compounding begins to work in reverse. It actually works against the investor in the retirement stage. So let's look at this retirement risk zone. It breaks it down into the accumulation phase. So all your working years where you're working and you have diversified asset allocation, you got great returns, you're putting money away, you're disciplined, your savings. We're ready for that great retirement date, and now we're going to start taking in income. Now in the retirement risk zone, which is when you start taking that money, poor market performance during this period can have serious long-term effects on a portfolio at a time when losses can be least afforded. Now let's take a look at a couple of examples. So we're talking about the retirement risk zone here. So what you're looking at are two same portfolios during that retirement phase, and over a 25-year period, they're both going to be averaging 8%. Sounds great. Entering retirement, both portfolios A and B have identical investments and the same amount of money, about $206,000. Like in the previous scenario, a couple of years of bad market returns are experienced, but they occur during different phases of retirement. So let's see how this is going to impact someone's retirement. The order in which the returns happen has a major impact. Portfolio A has negative returns at the beginning, positive at the end. Portfolio B has strong early returns, followed by some weaker returns later on. The two investors are going to draw out 5% of the first year value of the portfolios, which is about $10,000. Then they're going to draw 5% annually with an inflation adjustment based on a rate of 3%. Now, even though both portfolios start with the same amount of money at age 65, Portfolio A runs out of money at age 80. The investor in Portfolio B has withdrawn $208,000 more than Portfolio A by age 90, and their portfolio is valued at almost $800,000 more compared to A's, which is 0 at age 90. Okay, on to the next major risk, longevity risk. Now there's a joke and there's a fact that we're all living longer. They say the new 125, the new 150 is the new 125. We all know the new 60 is the new 50, the new 40 is the new 20, the new 70 is the new 50. The fact is we're living longer and we're feeling younger. If we look at the fastest growing segment of the population, that's the centenarian club. Those are the people over the age of 100. And the number of centenarians jumped from 22% from 2001 to 50% from 1990 to 1996. So we're talking about retirement here. We're going to break this down now into 3 phases of the life cycle. You got your education, you have your working careers, and retirement. And everyone is so focused on education and working careers as being the most important. But the reality is, the average person retires at age 58. Some of us earlier, some of us later. But if you're in good health at age 55, regardless of whether you're male or female, there's a very high chance you're going to live into your late 80s. Now, retirement can now be potentially the longest phase of your life. But that's going to come with many risks. Literally, 30 years, that's 11,000 days. So we got to be prepared here. The challenge is that we're going to live longer. But the question that every retiree and client of mine asks me is my income going to last long enough? Compared to previous generations, both male and female can expect to live longer, healthier lives in retirement. But this also means you can expect to fund your retirement for 25 to 30 years with the potential to outlive your income. Additional resources are going to be required to maintain a comfortable standard of living, and how well you do is going to depend on how well you achieve savings growth and the proper planning you did to prepare for that. Another challenge with longevity is interest rates and inflation. How are you going to maintain your standard of living as you age? When we're looking at a retirement period that lasts 20 to 30 years or more, you have to consider the effect that inflation will have on your retirement savings. Inflation constantly erodes the buying power of your savings. To illustrate this point even further, let's look at the price of a cup of coffee in a restaurant that has risen 560% since 1976, and a simple postage stamp that has gone up over 600% in the last 30 years. We look at a Starbucks cup of coffee, it now costs us almost $2. Sometimes even the fancy drinks cost us $5 to get what used to cost us only 25 cents. The fact is, many North Americans are extremely concerned that retirement income will not be able to keep up with inflation. So we're going to talk about here a couple key success factors for an amazing retirement. The first one is financial comfort. Now, if you talk to any financial expert and they tell you you can retire on 60 to 80% of your last year's income, they are making some very big assumptions. Number one, your house is paid off. Number two, you have no debts. And number three, that you never want to do anything else in your life, travel, hobbies, etc. The way we like to break it down to understand financial comfort is to have different pots of money, 3 different financial pots that are going to work for you at different times when you need it. The first pot is called cornflake dollars. This is the bare minimum, money that you absolutely need for food, clothing, and shelter. Then you have your entertainment dollars, money that you can spend having fun for all the things that you hadn't done before retirement that you're looking forward to doing and crossing off that bucket list. Then you have special event dollars. These are things you know are going to hopefully happen in your life, but you can't necessarily plan for. Gifts, replacing a car, upgrading that car, fixing that leak, that broken roof, or weddings, or helping out a family member, or helping out your future grandchildren, or your grandchildren at the moment. Well, let's look and understand what the financial planning for retirement is in terms of these cornflake dollars. Forget all the luxuries. Let's talk bare necessities here. Minimum savings needed to support 3 meals a day, 2 people, 365 days of the year, 20 years of retirement. Average cost of a meal, $10 per meal. How much do you think you need to save just for the basic cornflake dollars? 100,000, 200,000, 300,000. The reality is you need over $400,000 just to satisfy your minimum bare bone fixed expenses. Okay, we're moving on to the third risk. And this one is really one of the most important risks, and it can have a significant impact on your retirement and your assets if it's not planned for properly. So, the second key success factor to a great retirement, the first one we said is financial comfort. The second one is healthy aging. And here's what's funny. Most successful people, like yourself, will spend their lives trading their health for their wealth. But when they're older, they end up spending all their wealth to buy back their health. And we have some solutions to that problem. Talk about healthy aging. Health is most often cited as the #1 priority for successful retirement. If you don't have your health, what do you have? It makes sense, right? The healthier you are, both mentally and physically, the longer you will likely live, and the more you'll enjoy your life. You can have a lot of money, but if you don't have your health, you really can't benefit from a lot that your money can do for you. So let's look at that. What happens if we got our health, and we have our pension, and we have our savings, and the household bills, children's inheritance we're going to leave behind, we've got car expenses, and all those beautiful holidays we're going to take in retirement. All those things are great, and we could have done all the planning and saving in the world. But the fact is, if you don't have your health, then this is what happens. Everything suffers. Your pension money suffers. Your saving erodes. Your household bills increase. Your children's inheritance disappears. Car expenses go up, and you can kiss those holidays goodbye. So, let's look at these health risks and what's been happening over the last century. 1900, top 3 causes of death: pneumonia, tuberculosis, and enteritis. We fast forward a century later, and 70% of these deaths now are caused by cancer, heart disease, and stroke. And we can see that because it's all over. We've all been affected by someone, whether it's a family member or a friend, who has gone through one of these difficult times. And all the charities and media trying to raise awareness and raise money to battle these illnesses is telling us that it's really real. So I want to look at some of these top 3 critical illnesses in a little more detail, not to scare you, but just to look at some hardcore facts. With heart disease, 1 in 4 will contract some of heart disease, and 1 in 2 will have a heart attack under the age of 65. That's the bad news. The great news is medically we're improving, technology we're improving. So the reality is 80% of these heart attack victims are actually surviving. So what's happening is we're going through traumatic experience, and we have no idea how that's going to impact our financial situation, and more importantly, our retirement. Stroke. 1 in 20 are going to run the risk of having a stroke before the age of 70. And a third of the stroke victims are actually under the age of 65, not over. So when you're asking yourself, can it really happen to me? Yes, we're all susceptible to this. After the age of 55, the risk of stroke doubles every 10 years. Stroke is the leading cause of transfer from hospital to long-term care. And why I put that point in there is to illustrate the fact that when we're in the hospital, we're being taken care of, whether it's for a day or 2, a week, 2 weeks, maybe a month, a few months. But once we get transferred from the hospital into a long-term care facility, or we need long-term care, that's when expenses go through the roof. And those are things that if you don't plan for, can really disrupt your financial plan. Again, there's good news. 75% survive the initial event. The death rate from stroke has decreased by over 50% since 1950. The third one is a big and powerful cancer, unfortunately. 1 in 3 are going to develop that life-threatening cancer. And incidence of cancer have increased 1% annually since 1970. Now, one of the big misconceptions is when it comes to these critical illnesses is that we think we're going to be covered with our health plans. But 67% of costs associated with cancer are not covered by government health plans or private health care. Can this really happen to me? Yes, 3 out of 4 families will be affected. Please, it shouldn't be yours. But for women, the major cancer that we're all aware of is breast cancer. 1 in 8 are going to get it. And for men, it's going to be 1 in 9 which are going to develop prostate cancer. However, again, the cancer survival rates are amazing. So, what do we need to learn from this? What we need to learn is we're going to have some serious financial needs if we go through one of these critical illnesses. And what's going to happen? You had your job, you made all this money, you're in your retirement, and you're enjoying this retirement. And now life threw this curveball at you. So you're trying to get through this. Your earning power is lost. Family income, lifestyle, retirement, your investments, your children's education plan. Most importantly, you need emergency funds for expensive medical bills and daily living expenses. Financial health of an ailing person can also become a contributing factor to your physical health. It's not just financial. And we all know that we've experienced one of these illnesses with a family member or friend, and we've seen what they've gone through. And the fact is, I don't know one person that wouldn't spend every dollar they had to find a medicine to get better and live longer. So we need this extra pool of money. But where are we going to get it from? You're going to want it to do a few options. Pay off a portion of all your debts, or this critical illness might have forced you to retire earlier than you would have planned up, so you need some extra top-up retirement savings. The medical costs we just discussed, they're not all going to be covered under your current government plans. There's going to be all kinds of alternative therapies, special vitamins, dietary supplements, and expensive medication as well. When you go through certain one of these critical illnesses, there's going to be certain things you might need. Lifestyle improvement for equipment, whether it's special equipped vehicle, motorized vehicle, therapeutic equipment, or renovations to the home. Acquiring services you never thought you needed, the cost of caregivers and childcare while undergoing treatments, chauffeurs, therapists, shop at home services. The reality is, when you're going through a situation, you want to be prepared financially to just focus on getting better and spending time with your family. Because if you don't, there's a couple of things that are going to happen. The burden is either going to be placed on your children, or you're going to have to liquidate some investments or assets that might be at a loss in the stock market, that might have significant tax consequences, and you're going to be far better off having a plan, a financial product in place that's going to help you during this time than you would be to have to liquidate something you otherwise would not want to. So let's put this a little bit into perspective here. Does your financial plan include provisions for the following? Talking about long-term care insurance. There's critical illness insurance. Do you have an additional emergency pool of capital? Do you have life insurance for your loved ones if you drained all your assets as a result of needing this care? Because what life insurance is going to allow you to do is to literally spend every penny you have in your RSPs for your good times and bad times, and still leave a nice little nest egg behind for your loved ones or a charity. So let's talk about this insurance and put it into low perspective. We all have house insurance. We all have car insurance. The chances of actually claiming on house insurance is 1 in 1,200. The chances of claiming on auto insurance is 1 in 240. The chances of claiming on long-term care insurance after the age of 75 is 50%, 1 in 2. So this is something that isn't just likely that's going to happen, but we know that the financial impact is going to be significant. Okay, we're going to briefly talk about tax risks and proper estate planning. There's a serious need for estate planning, especially when it comes to the debts of death. There's probate fees, executor fees, legal and accounting fees, value of private or public shares, equalization issues, family and social legacies, and finally, the final tax return. So let's understand how all the different taxable assets work together, because a proper estate plan must consider the entire financial picture. If you remove and just focus on one little piece, it can be a downward spiral when it comes to everything else. We have our personal assets, our business assets, our principal residence, personal property, registered assets, as well as non-registered assets. So here's the plan. In a perfect world, we live a long, beautiful life. We pass away peacefully, and we leave all our money to our spouses and our children. And here we have 3 beneficiaries. But here's the reality. There's that 4th evil child, and his or her name is taxes. You can easily lose 50% of the value of your RSPs and 25% of the total estate value if you don't have a proper estate plan. Now that's the problem. What's the solution? The solution is life insurance. It's an amazing financial instrument. It can allow one to create a large pool of capital tax-free. It creates an instant estate plan with the stroke of a pen. There are many wonderful uses for it, including estate planning, maximizing inheritances, charitable giving, tax-deferred income, and etc., etc. We won't spend too much time talking about it, but there are amazing, powerful solutions that can transfer wealth within corporations to the shareholders and personally from spouses to the children and other charitable donations. But what are the other options? You really have 3. You can do nothing, you can self-insure, or you can borrow money. Let's take a quick look. To do nothing, that would be the easiest solution. But you're going to place the burden entirely not only on your estate, but also your kids when they have to pay your huge tax liability at death. And the estate might be forced to sell assets just to cover the tax liability. Now these might be assets that you wanted for your kids, for your grandkids, for your great-grandchildren. So do nothing is going to be the most costly approach and the less productive approach. What about self-insuring right now? What if you just put the money away right now safely in a savings account? Because you know what the tax bill is going to be, you need this money, but you can't put it in the stock market because you have to have capital preservation. You can't afford to lose any money. So it's better than doing nothing, but it's very sensitive to interest rates, and it's still very costly. Lastly, you could borrow. It's definitely not cost efficient. It's going to come with, we can assume a loan rate at 5, 6, 7%, and hopefully that loan's going to be repaid back over the next 10 years by your spouse or children. But what if something happens to their financial situation and they need to sell something and they can't recover and they can't pay back that loan? So it's very simple. Life insurance is generally cost less than 1% of your overall assets. It's pennies on the dollar. And 9 times out of 10, it's the most cost-effective solution, and it's the most productive solution, and it's the best way to transfer wealth from one generation to another. So we talked about a lot of things today. We spoke about a lot of risks. And when they all put themselves together from the ages of 25 all the way to 90, 100, and beyond, there are a lot of pieces to the puzzle, and there are a lot of products involved that can be used properly and when structured properly to really create a smooth transition between the different phases of life. Because at the end of the day, my firm and other financial advisors are trying to create 4 things for our clients. We want peace of mind. We want there to be independence. We don't want you worrying if you live long, which is amazing, and you're going to outlive your retirement, that you're going to have a guaranteed income stream for all the years that you live throughout your retirement. We want you to have your dignity. God forbid you were to suffer a critical illness. Most people don't want to place that burden on their children for them to have to dip into their savings and potentially affect their retirement. And lastly, when we pass away, a lot of us want to leave a legacy behind, whether it's to our family or to a specific cause or to a charity. And when you put those things together, that really creates that proper financial plan. So, the Abrams Financial approach to retirement, with all my clients, we try and address 3 key things and 3 objectives. We want to reduce your risk, and that was the topic of conversation today. We addressed market risk, longevity risk, and health risk. When we reduce those risks, we also want to reduce your taxes. Now, we could spend a whole other webinar talking about taxes and all the great ways to minimize the tax burden of death. But when you reduce your risk and you reduce your taxes, the bottom line is you're going to increase the wealth for yourself and for your loved ones. Just really quickly, some other services that we do provide: different life insurance structures, some tax mitigation, tax preferred investments, estate maximization, and financial and retirement planning structures for you to give you peace of mind and give you that retirement that you so longly deserve and should have. So again, my name is Dale Abrams, president of Abrams Financial. We spoke about a lot of things here, but we didn't get too much into detail into products and solutions. Everyone's retirement and everyone's situation is different. It's involved a customized plan, and I want to thank you again for taking the time to listen.